All right, what's going on, guys? This is Hugo from Snowball Hustle. Thank you for joining. Just want to go over a quick summary of our channel. For those that are new, pretty much the point of this channel is to teach you how to grow your account slowly and with very safe option trading. The majority, I would say 90% of my portfolio is selling options. I do buy some options here and there. But the majority of them is mainly just selling options and how to consistently create income to grow your account, right? So having said that, let's jump in. Today, pretty much what I'm going to do is I'm going to go over some of my positions, what's expiring today, what we're going to roll out. And then what I want to highlight on is this particular play on Intuit. Basically, I purchased, long story short, I follow this gentleman on Reddit. He's very good. He's had some good success. Unfortunately, I purchased some Intuit calls following a play of his, and Intuit, to my surprise, and I think to everybody's surprise, hasn't really performed the way we all thought it did, even though it did phenomenal on earnings, and the moat is phenomenal. So I'm going to cover how to turn that trade into a winning trade, and what I've done to do that. And that is pretty much called a poor man's covered call. So near the end, I'm actually going to spend a little bit of time kind of going through the logic and understanding what a poor man's covered call is. So that way you in the future, if you get caught in a position where you buy a call for a very expensive amount and it doesn't go the way you intended it to go, then you have the option to minimize your losses or maybe even create a win. So let's go ahead and jump in, guys. I see here, good morning. Good morning, Megan. How are you? Thank you for joining. All right, let me clear my notifications here. So first and foremost, let's go over to my portfolio. Everything I do is live, full transparency. I show you my wins and I show you my losses. Picture layout. How the heck do we do this real quick? Oh, yes. Okay, present, share screen. On my previous stream, we went through the tracker that I use to kind of track my trades. That's probably the most important thing, is tracking those trades. So make sure you do that. You know, if you need a copy of my Excel, I'm more than happy to give it to you. It's very simple. But the reason why it's important to track your trades is because, you know, right here with option trading, you're playing in the 1 to 2% kind of profits per month, maybe weeks, some weeks, and you have to be very disciplined in tracking those percents, because the key in option trading is that those percents add up, right? At the end of the year, you're looking at 20-30%. You know, we're looking at my year to date, and you know, so that's really the key with option trading, is keeping track. So right now we're up 35%, about $52,000. So let's go ahead and dive in. Let's see. It was kind of a high green day, turned into a low day. So let's jump in. Let me make sure that we are live on all the other places as well. Let me just check here real quick. Live. Okay, cool. All right. So let's go ahead and jump in. So look, full transparency for those that are new, the majority of my shares are in Tesla, right? That is a conversation for another day, but I am a big believer in Tesla. I think Tesla is a phenomenal company, and sorry, just making sure I'm good here. Okay. All right. Tesla is a phenomenal company, and it's a personal choice of mine. The majority of my gains have been on there. But I think the point is to look at the percent gains on each one of my trades. That's what, you know, if you're not in Tesla, that's what you should be, you know, kind of. And option trading is really like riding a bicycle. You know, you can watch all the videos you want on YouTube on how to ride a bicycle. You can do everything you want, you know, ask your friends how to ride a bicycle. But at the end of the day, you're going to have to get on that bicycle, and you don't have to go fast, but you do have to pedal, right? And that's the idea behind this channel, is that even if it's, you know, I think the cheapest amount that you can start a wheel, obviously there's stocks that are very cheap, but I would recommend maybe something like SoFi, you know, I think it's trading at $7.50. So 100 contracts is $750. So for $750, you can go ahead and start the wheel and start playing with selling calls and selling puts on SoFi. And if you track your trades, you know, your goal should be making a profit 1%, 0.5% a week, a month, whatever it is, but consistently make a profit is what your goal should be. So let's go ahead and get into it here. So I've got two Bitcoin miners that I usually stayed away from, and I just, you know, you can't time everything. I started selling puts on it at a very bad time. So right now I'm in the position of making this a winning trade and kind of manufacturing the win, if you will, as TJ the Wheel Deal highlights. Manufacturing the win happens over time. It doesn't happen that same moment, right? So you got to be patient. So right now I have CleanSpark. CleanSpark I have a few positions open on CleanSpark. It's trading at 8.57. Average cost right now is $15.85. I've got 500 shares, so I am taking a pretty big loss on the shares themselves, right? But here's the kicker, though. If we go to my tracker, right, and we go to CleanSpark, I've been selling puts and covered calls on this position now since since July, and I've captured $3,108 in profit. So when I come over here, right, and I look at my 500 shares, my adjusted basis is really $13.59, right? So $13.59 is my break even. So my point right now, so it's not 15. So my point is, you know, I'm continuing to, I have a bullish outlook on this stock. That's probably the most important thing. And I'm just continuing to write calls on it. Maybe even sell some puts. I've got some $8 puts expiring next week. I've got some 8.5 the week after that. Right now it's at 8.66. So, you know, it's cutting it close, but at the end of the day, I'm really not concerned. I think September is not a great time for Bitcoin, and these mining companies are very correlated to Bitcoin. So I'm not concerned on it. I've got two calls that are expiring today, 950s, you know, so, you know, what was I sold those for $17, nothing crazy, 30, 40 bucks, you know, but remember, it adds up. And that's why it's important to do it, to track it, because $40 plus $40 plus $40 plus $40, you're looking at $200, $300, $400, you know, so that's why it's very important. Into it, you know, let's go ahead and leave that one till the end, just because it's one that I'm going to focus on the poor man's covered call. CleanSpark here, I've got $10 calls next week. Those are, you know, I'm not worried about those at all. $8 puts next week, it's at 8.65. Not worried about those either. SoFi, let's go ahead and jump into SoFi real quick. SoFi is trading at 7.33. It actually hit a high last week of $8. I got assigned on 100 of my shares at $8. So I'm not complaining. Very small percent of my portfolio, 33%. I've got 900 shares, may take it up to 1,000 shares. But right now what I do have is I have $7.50 puts for the 13th. So for next week, right now it's at 7.33. So these are in the money. I do think that with the rate reduction, SoFi is going to react positively. So I'm not concerned about these 750s. And look, worst case scenario, I rolled them back down. But the fact that it broke that trend that wasn't letting it go above 8 is very telling. So I'm very confident. It's a good stock, solid company. I'm going to leave this one alone. These $8 calls in January, I actually had rolled these out, right? So that's the reason why they're so far out. You know, if we go to my tracker real quick, this is that current trade, right? So I've rolled it twice already. First time I rolled it was for a loss of 170. Second time I rolled it was for a loss of $320, and I collected $590 for credit from rolling it to $7 to $8, right? So something to keep in mind though is, even though it's technically a loss, right? So if I collect that full premium, $590 plus the $320 loss, right? So let's do it. So it's a $590 plus 320 loss, and 170 loss. Even if I collect, that's $100 a premium, right? And I have to wait until January 17th, 2025. That's not a great return. But remember, it's not always about the premium. Apart from collecting $100 on the premium, I'm doing $1, right? $1 times 100, so it's $100 of share appreciation from, because my strike got moved up from $7 to $8. So I rolled it up to $8. So in reality, it's $100 from the premiums if I let it get called away, right? So if come January, I'm like, you know what, I don't want to deal with SoFi anymore, I'm going to let it get called away. I keep the 590. So I make $100 on option premiums, and then I make $100 on the share appreciation from $7 to $8, right? So that's times 5. So that's 500 plus the 100 here. So that's 600, right? And so $600, and let's just say the total cost basis is $7. Let's say I bought them at $7. So $7 times 100 times 5 is what is that? $7 times 100 is 700, and then we do 700 times 5 is 3,500, and it's 3,500, right? So if I was to do $600 into $3,500 times 100, that's a 17.14% return. So that's a 17% return on my money, right? If I just leave it alone until January 17th, I'll take it. I mean, that's without having to do anything. Now, two things are going to happen. Either SoFi goes to $9 and then I roll it again come January up, right, and continue on that share appreciation. I can either just let it get called away at $8, get my money back, keep my premium, and do something else with my money. Or SoFi is below $8 by January 17th, in which case I keep my full premium. So this trade turns into a win, and that's it. And then I keep my 500 shares and I just continue selling calls on it, right? So it's really, we just really manufacturing the win on this particular play, right? So that's why it's important to keep track of the percent gains, because it helps you make those types of decisions. Now, I've got $7 puts, $8 calls, and then these $7 calls as well, which I rolled out from, I rolled these $7 calls from, there were $6 $50 calls. So I got caught underwater with these, right? But again, I'm trying to hold on to the shares and really capture that share appreciation. So I rolled them out till January. I think I did the math on this $7 call, and it was a very similar return, you know, double digits. And at the end of the day, look, that's a phenomenal return on your money. The fact that if you were to put this in treasuries, and, you know, treasuries is considered the safest return. Treasuries right now is getting you, you know, the 4 weeks is getting you, I think, like 5.2%, 5.3%. I've got some money in that as well. You know, so if you compare 5.3% in a year to 17% when your options are pretty, you know, there's really very limited downside unless SoFi commits, you know, some big mess ups. I'll take that. You know, I'm willing to take that risk. All right, so we covered SoFi. Now we've got TSLL, right? TSLL is interesting because I had bought $9 calls. I bought some calls a while ago. I bought them actually not so long ago either. I bought them on the 26th. So this was like a week and a half ago, right? And I bought them for $275. I had bought 10 of them. So right now I've only got 3 left, and I've just been selling them. I sold them off yesterday. So this particular trade is making me about, you know, $1,000, $1,200. Now with TSLL, I do have to keep an eye on is the fact that I have this $7 put, which I sold some $7 puts on TSLL. So TSLL is pretty much Tesla bull, their leverage shares, right? So if Tesla goes up $1, this is supposed to go up $2. If Tesla goes down $1, this goes down $2. So it's riskier than even Tesla and more volatile. So you got to be careful. But, you know, I do have my opinion on Tesla. So I sold $7 puts on it for December. So this is one of those, you know, put away and forget kind of plays. I have $9 calls. So these are the $9 calls I bought for March 2025. And then I sold some calls, some $11 calls for next week on this, which I may buy back right now. These are, I got $27 for them. I may buy them back on Monday. Tesla is down today, so I may actually buy one of them back just in case Tesla just decides to ramp up again tomorrow. At least I have, I'm not covered by that $11, which I can always roll it out. If I do get caught underwater with that $11, I can always roll it out. But you always want to be playing both sides of a trade as much as you can, right? So if I zoom in here and I go into my TSL play, basically right here, and for those that are new, I'm going to quickly cover what this thing tells me, right? So right here on the left, this tells me the ticker. This tells me when I open the position. This tells me what type of position it is. It tells me my expiration. So when that option expires, my strike price, contracts, how many contracts I bought or sold, what premium I collected on that contract, how much total premium I collected. So this is my premium times how many contracts, so my total. This tells me if the option trade is open or closed. This tells me when I closed it, how much I closed it for, what was my total cost to close, and then the profit. So the profit is really looking at how much total credit I collected, how much I had to pay to close it out, what my profit is, and what my return is on that particular trade. So these are how I track my trades. So if we go into the TSLL, I'm looking at 270 cost basis times, I got 3 here, 3, 2, 3, 1. These are all the ones that I bought, right? So if I add this up, it's 10. So I paid a total of 2,751. And right now, I've made a total of 630. I've got a few more here that are still kind of tied up, but pretty much I made 320 here, 210, 75, 25. I sold these a little early. So calls sold, I have a $913 $11 one, which is still open for 89. I've got other calls sold here, 2 more here. So I'm gonna, this $11 one, which we bought back for 48, was it? I believe it was 42. So today is 9/6. I bought this for 42. So I made $47 even buying it back early, right? Now, obviously my average is different than what it shows on Robinhood because I sold the other 2 $11 ones for really low, for $12. So it averages it out to 42, but in reality, it's not. I really am logging in a win here, and then maybe I'll let these 2 expire or roll these out. So that's why it's important to track your trades again, because Robinhood just blends everything in, and it's not exactly the best, right? So, and look, honestly, if TSLL dips further or dips again into a point where these calls are going to be worth 275, or I can scoop them up for this amount, I'm going to be buying a lot more of these. So maybe that's a trade you want to follow me on. So TSLL, Amazon, that's one of these poor man covered call plays that I've been that I'm going to be covering. Sometimes they go well, sometimes they don't. The most important thing with these calls when you're doing, and I'll get into this into detail later, but you have to buy them out for a fairly long time, right? So buy them out a year out. And the reason is because the theta decay, right? Because an option, when you look at an option contract, it's composed of 2 things, right? And this is getting a little bit into the intricacies. So, but it's important to understand because that way you can make the right decisions. An option is really 2 things. It's extrinsic and intrinsic value. Intrinsic value is the value that the option has based on where the option is and where the stock price is, right? So if Amazon AMZU, which is another leveraged ETF, is at 32 and I'm buying a $30 call, I'm basically buying $2 worth of intrinsic value. So, right, $2 are intrinsic already in the option because it's at 32 and you're buying them in the money. So right off that bat, that call is going to be worth $2 plus the extrinsic value, which is the time that you're buying. So you're buying, a year's worth of time. That's going to add another, $2, $3. So that's how you get to the call pricing, the call cost of, $3, $4, $5 or whatever it is. So if you buy them far out enough, the decay on that time is very slow because it's so far out. So your option doesn't lose its value very fast. If you buy them short dated, like this Amazon $30 call, which expires 9/20, the time decay is very, very fast, right? So the stock really has to continue its movement upwards in order for it not to lose its value. And so that's one of the things with the Intuit call, and we'll get into it. So Amazon Riot, I'll skip these through. These are just another miners. Palantir. Palantir is one that I've been kind of playing as far as just selling calls in it. And I've been doing a strategy here where, Palantir went up to like 30, 32, 31. But what I did is when it was at 31, 32, I sold at 28. I rolled down my call, right? So this is another strategy, but instead of rolling it up to capture that share appreciation, I roll it down to capture that premium, right? And the idea is that Palantir will go down in price. I think it's overpriced right now, and I don't think it's going to be included in the S&P 500, which is going to cause it to go down. At that point, I may buy this option back if it does go down. I got $430 worth of credit, and I'm already up 130, right? And this expires at the end of this month. So we'll see how Palantir plays out. If anything, I'll just let it get called away at 28. If I add up 28 plus the credit I got, that's 28, 29, 30, 31. So I got technically $32.40 per share as far as profit goes, right? So I'm not concerned at all on this play. This is really just trying to squeeze money out of the market. So, Tesla, let's go into Tesla because that's probably my other large position here. So Tesla, I bought $173 a share. I bought 1,000 shares. I got caught underwater with these as well, right? And to be honest, I've done the math. I don't care if I have to roll these out for the rest of my life. I'm very happy with the way the premiums played out and my return. So, don't get greedy on it. Right now I'm underwater at 205, 200, and 205. The majority of them expiring in December. So come December, if it's under 205, phenomenal. If it's above 205, I'll roll them out for, another 6 months and capture another $30, $40 of appreciation, which when you're talking about Tesla, $30 is for, and I'm spitballing what it would look like, but let's, 30, actually, let's look at it real quick. If I was to roll these out now from where they are, because they're December, let's do 6 more months, right? So let's say I say, you know what, I'm going to go all the way to April 2025. If I was to roll these for a credit, so making money, I would have to roll these out to, it would allow me to roll them out to maybe 230, right? So there you go. Yeah, more or less 230, right? And I would collect 3,900 and I would have to pay to close this one out 3,920. So it would be pretty much a wash on the credits. But I'm gaining from 5 to 30, right? So that's $25. $25 times 100 is $2,500, right? $2,500 on my cost basis, which is this right here, 17,300 per share, per 100 shares. That's a 14% return. So just by rolling these shares for 6 months and still be underwater, I'm collecting 14% return, almost 15% for 6 months. So for a year, it's be close to a 30%. So that's why, I get it. Having your shares underwater is not exactly the best idea and you don't collect the most premium. But in the way I look at it is that, you have downside protection because if Tesla goes down like the way it did today, those contracts lose a lot of value. Look at on my options, look how much my today's return is, $5,000. So they lose a lot of value if they go down, and if they go up, you just continue chipping away. So it's really a win-win. So look, having said that, the point of this stream is really not to make it long, right? We got to make it 30 minutes max. If you guys have any questions, feel free to ask. If you want one-on-one consulting or training, I have about 3 or 4 spots left. So go ahead and shoot me a DM on X, and I can explain to you kind of what that process looks like. So let me go into the Intuit play, which is kind of the one that I've been discussing on Reddit for a little bit. So if I go to Intuit, right? So Intuit, right? This trade was started really with 2 positions, right? It was started with we bought a call, right? And we bought a really expensive one for like 2,400 right before earnings. And then I sold one, and then I bought another one for 420 bucks like the day after, right? So right off the bat, I think I had lost like $1,200. So my average for both came out to 1427. I'm sorry, 2854. So it was about 1,427 each, right? Now, what many people don't know is that when you buy a call option, you pretty much control those 100 shares. Okay, so while you don't necessarily own them, you do own them, right? It's like, think of like renting a house and throwing parties, right? You're renting the house, so you technically don't own it, but you can throw parties and collect money on the house, right? So it's a very cheap way to make money on those shares. So that's exactly what I've been doing. And I always start that play, always, because look, when you're buying an option for an earnings or a big event like that, the implied volatility, so what people are expecting the stock to move, is very high. And so because the implied volatility is very high, the premiums that you're paying are going to be very high as well. But that also means that the premiums you collect are going to be high. So when I open a position of that nature, I always buy a call and sell a call in order to mitigate my cost. And so this was my original my original purchase. So I bought the 690 1018, so October 18th, for 2,393. And then I also sold the 725, right? So if Intuit had just gone through the roof from 690 to like 630, 640, I could roll this out because I had plenty of time. This one expired the day after, I think it was, and no, filled 821. So this one expired 2 days after, and this one expired like 2 months. But at the same time, I'm taking advantage of that implied volatility, and I'm collecting $250, right? So at the end of the day, I'm really paying $21.50 for that call. So that was the first thing I did, and then I bought a second one for $460. And that's pretty much what I show here, right? So I sold the call for $725, $243. I actually didn't wait till expiration. I closed it early for $75. So I collected $168. I sold another call for $720. I collected $200. I let that one expire. I sold a put on it as well, which I have open. So long story short, I have a few options that are still open on them, but I continue. And as a matter of fact, let me see something here, because I think that I only sell calls on this on green days, but right now I have a 632 call and I have a 630 call. So I have 2 calls that expired today, 630 and 632. Right now it's at 625. So, will this go up to, let's see, if we look at the week, the highest it went up during the week was 635. So the highest it went up the whole week would put pressure on both of these. And that's fine, because then I would just roll these out. Not concerned. But more than likely, I mean, we're at 624. More than likely, these are going to be fine. I also have a 615 put, which I sold for $510. Now, if you're going to sell puts, it does require collateral. So this does require 615 times 100 worth of collateral. So that's $61,000 of collateral, right? So you technically, I mean, you don't have to do the puts. You can only just sell the calls on your Intuit, right? And then that way you can reduce your cost basis to a point where, you know, if Intuit does make you know, continues to go up to 630, 640, you may be able to just sell it early, because remember, the time decay accelerates as it gets closer to the expiration date. So I'm probably going to sell this in the next week or two, and pretty much, you know, manufacture a win that way. I don't really want to hold on to these. I like Intuit. I'll probably continue selling puts on it, but I'm not going to hold on to these calls, right? So that's pretty much what a poured man covered call is, you know, and TJ the Wheel Deal does that a lot. You know, if this actually would have made sense, and this actually may make sense, this may be something I do just on the side, you know, is buy a long dated call, you know. So I'll buy something that has what, 200 days on it, you know, and it's in the money. So right now it's at 620. So I'll buy this. You know, you're buying this for $6,000, which is fine, but you're collecting your premium on Intuit is pretty decent. So it's just, you know, something to keep in mind, and something to help you guys out if you got caught in a position where, you know, you're trying to manufacture a win from these Intuit calls, which didn't go so well, you know, and it was a good play. I mean, Intuit killed it. I think it's a good long-term hold. So that's pretty much it for now, guys. If you have any questions that you want me to kind of go through, any plays, or you want to share your screen and we can go through one of your trades, I'm more than happy to do that. I am checking comments on all platforms, and I see some comments but no questions. So, you know, please do let me know if you have one. Let me check one more platform just to make sure we didn't skip anybody. All right, I think we're good to go. So remember, guys, I try to do this every Monday and Friday when options expire and when we open positions. So, you know, feel free to join. Again, the point of this channel is to grow your account slowly and surely. You know, I know you all work hard for your money, and it sucks to lose money. It absolutely blows, and it's the worst feeling ever. And I think in our society, we've gotten too used to making money quickly and big money, right? So if you see consistent smaller money, you don't really pay attention to it, right? And that's such a big mistake, because the beautiful thing with options is that it's scalable. You know, it doesn't matter if you have $10 million on here, $6 million, like TJ the Wheel Deal, $6 million, or you have, like we talked about, $700 to start wheeling SoFi. You know, it doesn't matter. It's all the same principles, right? So you might as well learn it now when you are starting off, or you're young, or even if you're old and you're looking to do this for your retirement. You know, it's like riding a bike. You ride it for 6 months, and before you know it, you're going to be BMXing on this, you know. So just keep that in mind. Again, I'm open for one-on-ones. Got 4 more spots left. Those pretty much involve us coming up with a plan on stocks that you like, kind of, you know, holding your hand as you do the first ones, and consider me basically training wheels on your bike. So go ahead and shoot me a DM on X if you want to explore that. But apart from that, thank you guys. It's Friday, September 6th. It is 10 a.m. I wish you all the best, and I will see you here next week. Thank you.